So mortgage interest rates continue to hover around the lowest numbers we've seen in history, but who's eligible? What do market projections look like going forward, and what else is going on? I'm Chris with your Midweek Market Watch. Let's take a deeper dive. Our economic landscape looks tumultuous at best. Chapter 11 bankruptcies are up by 26%. Unemployment rates are set to hit 16%, and our GDP has shrunk by 4.8% since the beginning of the year, representing the largest contraction since the financial crisis of 2008. Yet despite this, over the past month, all U.S. stock exchanges saw their biggest gains in decades, with the NASDAQ leading the charge. Max Wolf of Multivariate said it best, likening the market to a chicken. It runs around fast and vigorous, appearing beautiful if you don't notice the piece that's missing, which just happens to be the head. How this all affects mortgages? The Fed, having bought up all those mortgage-backed securities to keep interest down, may have overshot. If mortgage interest rates follow traditional benchmark treasuries, we would be able to lock in rates as low as 2.25%. But that's not the case. In fact, the gap between mortgage rates and treasuries is the widest it's been since 2009. 3.8 million homeowners are in forbearance, meaning they've stopped making mortgage payments, which represents 7.6% of all borrowers. Meanwhile, mortgage servicers continue to deal with the liquidity issues, debts to their investors, and margin calls. Take Nations Lending, for example. They went from being owed $1 million in hedges to owing $5 million in just 2 days when MBS prices spiked. What does this mean for homebuyers? Things are taking longer to process, and unfortunately, if you have less than a perfect application, it may be more difficult right now to secure a home loan. However, since housing prices tend to follow home sales, and those are projected to be down by 50 to 60% over the spring season, we can also anticipate home prices to fall as well, estimated between 2 to 3%. Looking ahead, Federal Reserve Vice Chairman Richard Clarida announced that while we'll continue to see a drop in GDP and employment, we can look forward to a robust rebound with positive growth by the third quarter. This has been your Midweek Market Watch. If you found this content helpful, sign up for our newsletter for more such insights and tune in next week.